Stocks closing sharply lower after a hotter than expected December jobs report and a jump in inflation expectations. 10-year yield surging to its highest level since late 2023. Let's bring in Allianz Chief Economic Advisor Mohamed El-Erian. Mohamed, good to see you. So you combine those inflation expectations with the hot jobs report. What has to happen for this to be good, say, for an S&P that's already trading at a historically high multiple?
So first, it is good that the economy is doing well, John. We must not lose sight of the fact that U.S. economic exceptionalism provides the only locomotive of growth for the global economy. So as disrupted as markets may be, because this was a hot employment report, the alternative of a weak one would be much worse news for not just the U.S., but around the world. In terms of what it means for investors, investors are going to be increasingly pushed into a barbell, looking for high quality yield over here and being more opportunistic over here and more agile, including going to private markets. I think that what you're seeing is this transition from market-based investing to theme-based investing, and now it's going to be much more individual names.
Okay. Well, now also that we have this jobs report behind us, attention's going to turn to earnings, but we've got the strong dollar. So for multinationals in particular, how's that going to affect guidance?
Yeah, and we also have an inflation report coming up next week, as you discussed earlier. Look, analysts right now have to take seriously that the dollar index is almost at 110, the euro is almost at parity, and that is going to impact multinationals. And they should take that into account, and it's going to be a headwind to U.S.-denominated earnings from abroad, and just the reality of U.S. outperforming the rest of the world.
Mohamed, I'm going to ask you a question I asked Bob Elliott earlier, and that is, are the bond vigilantes back in this market? And by the way, not just here in the U.S., but globally, especially when we look at what's been happening in the U.K., for example.
They're definitely back globally. And what you see in the UK is that very strange combination of them having had higher increases in yields than us, and yet their currency has weakened significantly. That combination of high yields and weak currency, you typically see more in an emerging economy where bond vigilantes are much more active. So yes, they are back. I think what we are having here, Morgan, is not as much the bond vigilante as much the reality of three things. One is growth is stronger than anticipated. Two is inflation is stickier than anticipated. And three, we have the reality of high deficit and high debt.
I want to get your thoughts on this quiet climb we've seen in crude oil in recent weeks. Energy stocks are actually the best performing sector to start this year after being the worst performing in the S&P last year. But oil in general has been moving higher, maybe part of it's sanctions, but is it sustainable?
Yeah, I mean, you got a 3% move today. You've had a 10% move over the last few weeks. This is significant, and it adds to the inflationary pressures. The one today is purely in terms of sanctions on Russia that the market believes will be much firmer this time around than they've been in the past. So you're looking at a supply side issue. And the big question for is whether OPEC Plus OPEC in particular, because the plus side is Russia, but OPEC and Saudi Arabia in particular will want to increase production. But this is all supply side. It is not a demand issue, it's a supply issue.